I think the more we go down this path where international events appear to exhibit some sort of contagion,
Yep.
you know, like is Venezuela going to precipitate another crisis in different parts of the world, Turkey,
Yeah.
other
I mean,
parts of South America?
Personally, I don't think Venezuela has got broader issues outside of the borders, but it does fit into, I guess, a wider tapestry of emerging markets.
Right. So it might not necessarily cause other issues, but it could be correlated to these other situations that are happening.
Yeah, absolutely. So, you know, these countries, emerging countries that we're talking about, are countries like Turkey, Argentina, Brazil gets lumped in there, South Africa gets lumped in there. So these are countries that, you know, you wouldn't say developed, but they are sort of, some of them are on a trajectory, perhaps heading that way at some point. But a lot of these, you know, we're seeing a big devaluation in currencies of some of these emerging markets in recent weeks and months. So Turkey is one example, and both is Argentina. And this actually is related to a wider issue around global financial markets. And that is, at the moment, the Federal Reserve and other central banks are starting to tighten monetary policy after loosening it for a number of years following the global financial crisis. So they pumped a lot of money into the system to try and get inflation up. Now inflation looks like it's coming back up. Growth in the United States is doing well, so they're starting to just keep things in check. They're starting to pull back the stimulus.
We touched on this before, didn't we?
Yeah.
And I think this is probably the common thread in that tapestry, isn't it?
Yeah.
Yeah. That is what you just said. But I guess you put out all this cheap crack,
Yep.
right? Which is what it is. Everybody gets hooked on it.
Yep.
And then you start pulling back on the supply and making it more expensive.
That's right.
You're
but
going to have
only
problems.
gradually, because there's that uncertainty, because, you know, how much independence has that created in financial markets. If you pull this stimulus away too quickly, then, you know, you could create all these other issues. So
Right,
just
and lose faith in that.
Yep.
Right, okay.
But markets are looking at this and they're saying, okay, so the Federal Reserve is starting to, say, lift interest rates. And as a result, interest rates in the US are higher generally. There's a little bit more yield that investors can get. Previously, they'd gone to emerging markets like Turkey and Argentina and whatever to get high yield at that time. And all of a sudden, they're like, well, it's not necessarily worth the risk of putting my money in these emerging markets relative to now interest rates going up in the United States. So they're starting to put that money back into an economy like the United States.
So and that's further exacerbating the issue.
Yeah, so that's lowering the currency in places like Turkey and Argentina. Right. And the issue with that is these countries, unlike New Zealand, don't have the luxury of being able to borrow money. They have to borrow in foreign currency. In New Zealand, we're quite fortunate because when we borrow, the investors are the ones who are happy to hedge the currency. So we effectively borrow in New Zealand dollars. And it's the investors that take the risk on the currency. And because our economy is stable, you know, we've got stable power, we've got an independent central bank and all these things, our credit ratings is high, investors are willing to take that chance. They know that we're good for it, basically. We're emerging markets, there's much more uncertainty, so they have to borrow in US dollars. So when the US dollar is appreciation, as it's doing now, all of a sudden servicing those loans, so paying interest rates, all of a sudden starts to get very expensive.
Double whammy.
Double whammy, that's
right. So the
right.
currency's not in your favor and the interest rate's not going the right way.
That's right.
And you've got no choice. So it's kind of like it would be the equivalent of you taking out your next mortgage in US dollars.
That's right. Yep, exactly.
You're going to be struggling with each mortgage payment because it's going to get higher in the New Zealand dollar currency.
Yep. If as a New Zealand dollar weakens, then you have to pay more to cover your interest costs. So it becomes more and more of a burden. And that's what's happening in these countries at the moment.
Right. So this whole common thread, this quantitative easing piece, where you're putting out all that crack out there, now you're making it harder to get, it's more expensive, and Venezuela, no doubt that's one of the factors in Venezuela, but it's also Turkey, Argentina, Brazil.
Certainly more of an issue this case for Turkey and Argentina and South Africa. Right. And you've seen sort of a coordinated, depreciation in all these currencies. So
well, even in the, like I'm thinking about the New Zealand dollar.
Yeah.
In the last 3-4 months, it's gone down quite a bit relative to the U.S. dollar. So it's almost like this picture of the geese are flying north for the winter type thing. Yeah. All our dollars everything's going, and you look at the stock markets and they're going up.
They're still going up. Yeah.
They're still going up, and clearly there's a flight of capital happening, and it's going in that direction. And you mentioned something really interesting before, where you don't really want to do it too fast because that has problems of its own.
Potentially, yeah.
Potentially. Do you want to just cover that a little bit?
Yeah, so quantitative easing, when it was brought in, probably around 2010 and 2011 or so, it was somewhat of a, some people might say a bit of an experiment. So it was something that was a very blunt tool to shore up. So central banks, following the global financial crisis, they cut their interest rates dramatically. Even here in New Zealand, we cut ours dramatically. They did in the US and UK and all that. So they put all the stimulus in, but then the economies still weren't doing that great. You know, it softened the blow, the big blow of the financial crisis a bit, but the economies came out of this crisis very gradually. So growth was very slow, inflation was weak, productivity's been weak, wage growth has been weak, and there was a risk that low inflation could start to fall and turn into deflation, which is on the other side of the spectrum of hyperinflation, deflation, which is also a very nasty thing to happen in a country. So they decided to put in some more stimulus, and because interest rates were so low, they kind of had used up that, even though some countries...
There's only so much you can go, right?
Yeah, even though some countries actually have cut to negative, but they decided, right, another thing is just to pump money into the financial system, and that's what they did. So central banks bought up bonds for financial instruments in markets. So they went in there, they said, right, give me that, here's some money. So they took so essentially they increased the demand of these assets. Interest rates are inversely related to the price, so demand increases the price, but interest rates came down. And that idea of keeping interest rates not just your cash rate or your base benchmark interest rate at the short end, but also flattens interest rates at the longer end as well. So
outlook for interest rates flatten out, so you flatten out the yield curve long term.
So it pushes investors away from interest assets and into others, such as equities.
And that's why asset prices go through the roof.
That's right, as a consequence. And when they start, so that helps support a bit more of a recovery, but there's a risk that people got too addicted to it, that if this tap is turned off too quickly, they start selling the Federal Reserve or the central banks start selling these assets, that all of a sudden you'll start to see interest rates increase too high or too quickly, and asset prices fall dramatically, and that can have a huge impact on confidence. So, you know, there is a wealth effect associated with increases in house prices and equities as well, or shares. People will go out and spend a bit more because they feel wealthier. Right. But if opposite's happening, then you could have a large contraction. And so they just wanted to avoid that.
So, because the very thing that secured that is now worth less.
Yes, that's right.
So now it's actually riskier for the person giving you that money.
Yep.
Because you're not in the stronger position that you were in before, a strong as position.
Yeah, that's right. So you could see equity start to fall or pull back, and investors like, oh, I'm taking a bit of a loss here maybe, or my return's not that great this year, or I might maybe not go spend some money on a new Porsche or something like that,
as you normally would. But to bring this to just a really simple parallel, and I'm going to try to bring this to a real simple parallel. Again, think about typical household. They've got a mortgage, and they've just borrowed another $100,000 or $400,000. Isn't uncommon around these parts to do a renovation, and now their mortgage is colossal. But from an interest rate point of view, because the interest rates are so low now, and they might have just come off a really high fixed interest rate onto just over 4%. It's like, giddy up, we can borrow another couple $100,000 and we don't even notice it.
Yeah.
But then, I guess the lender is, the bank is in just as much of a vulnerable position as the borrower is to a certain extent.
Yep.
Because now they're the ones that are in a position where they don't want to make it too hard, or else they could strangle the golden goose. The household needs to be strong to pay back this mortgage. You increase rates too much,
absolutely
screwed.
And that's something that the Reserve Bank here is very aware of. And we know in Australia as well, so in some of their markets like Sydney and Melbourne, they're starting to see house prices pull back a little bit, start to fall. And they've as well very leveraged up on housing. And the Reserve Bank over there, they've got a very low cash rate of 1.5%. Ours is 1.75, so a bit below ours. And they're very concerned that if they hike too quickly, that it just puts too much pressure on households and the economy will start to nosedive too quickly. So it will be, I think, a process for central banks of a little bit of feeling as they go. So, how
little adjustments, right?
Yeah, little adjustments.
You're driving down the motorway, the faster you go,
do
the mess. just a little movement in the steering wheel.
Yep.
See how the vehicle reacts,
That's
and then
right.
bring it back. But
Yeah, that's right.
I guess that spells good times to me in terms of stability. Like if bringing this back to New Zealand and what the economic outlook is, I don't think we need to be so downcast about the next few years, because we potentially have quite a stable environment that we're heading into. Interest rates might increase, they might decrease still, they might stay the same, but it's not going to be a lot of variance, really.
Yeah, I mean, the general view in our view is that the Reserve Bank is going to keep its cash rate 1.75% for quite a while. We're not looking till around 2020 before they start thinking they need to hike.